Now, last night was yet another volatile session. There were conflicting geopolitical headlines, some good, some bad, and we actually saw oil whiplashing throughout the day as well. There was a dramatic collapse in the oil prices after it increasing 30%, and ahead of CPI that is coming out tomorrow. By the close, we saw major indices ended the day split. So when we look at the S&P, it actually closed 0.2% down below the 100 EMA level right over here. And now this is very clearly a resistance. Even though yesterday we saw prices push up as high as 6845, but it retraced back and actually closed below the 100 EMA. Now we can see that S&P is still holding this key technical support area around the 6726 to the 6758 area. And if we do see a break to the downside, expect that we might actually see it test around the 6600 area, which is in line with the 200 EMA. Now, looking at this, you can see that where are we in the range right now? There's two range right now. The first range is at the 69 area. And the second range is, of course, the all-time high area at the 7,000 region, which will be a very, very strong resistance. And as long as we are staying between this 67 to 68 area, market structure is definitely still under pressure. And despite relatively small closing move, there were large intraday moves, and it was defined by huge swings driven primarily by geopolitical developments, which I'm going to talk about later. But on top of what we are seeing today, I do want to share with you something that I found which it might actually change the whole market structure that we are seeing right now. Now, this was an article that came out yesterday. So there were trading desks at Goldman Sachs as well as JP Morgan warning that the recent volatility has triggered this thing called the CTA, which stands for Commodity Trading Advisor. It is their risk controlled deleveraging mechanism, and it has fully turned bearish, and systematic selling pressure may reach the highest this year in the coming weeks. And in such a scenario, markets could quickly retest lower levels. Now, with that said, I do want to share this might sound like a total fear-mongering article, right? But it's important to understand this because the Wall Street is actually being controlled by algorithm funds as well. So it's important to understand and look back whether this has happened before and how did the market react then. Now, to understand a little bit about this CTA, basically, this is their systematic algorithmic framework designed to manage portfolio volatility. And it basically means that these funds could become net seller of equities over the next month, weeks or months, regardless of how the market moves. And their model suggests that yes, potential CTA selling could reach record levels. Now, with that being said, this CTA has actually been shared before, right? It has actually flashed out a warning sign before, back in November last year, right? And it's very hard to say how this will pan out because when this signal was flashed out back in November, we did have some market corrections then, but then it recovered after. So it is possible that we might go lower, but this will only to prove to be long-term opportunities, especially if you are investing for the long term. Now let's look at oil because the swings that we saw yesterday, the dominant catalyst for the day was a dramatic collapse in oil price like you saw right over here. And as you can see, what actually happened yesterday was it was trading within the range. It went as high as $89, close to $90. And it actually went all the way down to 75 after some news, which we are going to touch on, before closing at 84. And right now, we are within the range of $83. Now, we are still at elevated levels. We are still at that resistance level that we saw from earlier. So it doesn't mean that things are rosy right now. So you can see where's the resistance level that we are seeing for crude oil. It is roughly around here. We are definitely still above it, right? If you plot all these resistance, $84, we are still at elevated levels, right? And where did this price come from? Where did the drop come from? How come there was so much volatility yesterday? It actually came following comments from President Trump, who told reporters that the military operation against Iran was very complete, and it suggests that the conflict will end soon. And the markets interpret this statement as geopolitical risks might be unwinding. And that's the whole reason why you saw oil prices actually went all the way down. And it actually immediately eased the fears of an inflation shock, which has previously threatened to derail expectations for future Federal Reserve rate cuts. And now, pertaining to yesterday, when we saw the intraday move of oil, there are a few things that actually happened which affected it, both oil and the stock market. The first was this secretary, Chris Wright, who is the energy secretary. He actually posted a tweet right before the market closed, saying that the President Trump is maintaining stability of global energy and that the US Navy has successfully escorted an oil tanker through the Strait of Hormuz, right? And if you remember, the Strait of Hormuz is a strait that where 20 to 30% of global oil passes through, and is what Iran is threatening to close. And no ships are traffic over there has gone close to zero since the war started, right? But interestingly, he deleted the tweet right after, shortly after, which got the markets thinking. So initially, when he wrote the tweets, the market loved it. Oil prices came down because the idea that war was coming to an end started to have some legitimacy. But thereafter, he deleted the tweet, which got markets thinking again that things might not be going as well as it seems. And right after that, the White House came out and denied that the US military actually escorted any tanker in Hormuz, right? So this was a direct response to the deleted tweet as well. So you can see this confirmed, and this is why we saw oil prices continue to go down right after that. But in addition to that, why do we see oil prices climbing back again? You know, you saw it went up to $70 over dollars, and now it is at $83. Why did this happen? Is because few hours later, there was another news that came out that says that Iran is laying mines in the Strait of Hormuz, right? And this is reigniting fears of supply disruption again. And the White House actually came out to calm the markets and said that US Navy could escort oil tankers if necessary. But think about it. You are reading this news that says that there are mines in this strait right now. If you are the one that is in charge of driving this oil tanker, would you drive past the strait knowing that there might be mines over there? You probably will not, because lives will be at risk. And that's why traffic is still close to zero over there. So this conflicting headline created a chaotic news cycle that contributed to the intraday reversals that we saw, right? And you can see Trump was angry, right? Trump was super angry. He wanted the mines to be removed immediately. And he said, if it's not, the military consequences to Iran will be at a level never seen before. And this comes after that he said that Iran will be hit 20 times harder. So you can see that he is not going to give way, right? He wants Iran's unconditional surrender. And Iran is also not a kind that will bow down. They are going to fight back. And even though with him saying it's very complete, with Iran fighting back, that's where the uncertainty comes from. And just 40 minutes after, he said that within the last few hours, the US have actually destroyed 10 inactive mine laying boats and ships, with more to follow. So you can see they are not backing down without a fight, and Trump is going to do all he can in order to win the war, right? But right now, it's still uncertain, right? News are coming out hour by hour, and it's very unsure what Iran will do next, what the US will retaliate next as well. And so we know that geopolitical events are dominating the headline, but later today, there is something important that is coming out, which is the February Consumer Price Index, the CPI. And it's expected to hold steady at 2.4%. And this will be the most important reading before the Federal Reserve meeting next week. Now, even though this CPI will release data from before the war, so it will not be inclusive of the price shock that we saw that was due to oil. Right, so imagine this was before the war. If prices comes in higher than expected, if CPI comes in higher than expected, that will not be a good sign, right? Coupled with what we are seeing with oil prices right now. And if it's hotter, you can forget about rate cuts, right? We can forget about it. In fact, for the meeting next week, there will most likely close to 100% not be a rate cuts. So do expect to see another layer of volatility if CPI doesn't come to expectations. Now, looking at volatility, we can see that volatility actually dropped roughly 10% yesterday, and right now within the range of 25. It is still an elevated level, like what we saw from oil. And in fact, we might see, if we do continue to see some uncertainty, geopolitical uncertainty, we might see pushback around the 28-29 region. So this is definitely reflecting a partial unwinding of fear, and there is that level of what we are seeing, an extreme panic level, and this is moving more towards a slightly less risky environment, but a very much cautious environment, though risk appetite remains limited, right? So we are still not in the clear. Again, we do want to see volatility at least going down to the 23 region, which we saw yesterday, but because of the new news that came out, it got pushed up further again. And until the war starts to simmer down, until we really see signs, not just Trump saying that the war is going to be complete, but Iran also showing signs, I do expect volatility will still continue to stay elevated, and until we go right below the $20 area, that's where we know things have much more stabilized already. And looking at Bitcoin, we saw yesterday after the news, it did actually push back up to the 70K area, but right now it is sitting right below. So the 70K has been proving to be a very strong psychological resistance. The moment it get pushed up there, it was just sold down right after, right? And this actual move of the price, Bitcoin actually going up above 71K, right? Close to 72K, it actually triggered about 186 million in short liquidation. And right now we are seeing this level of resistance about the 71K, and the support is still around 66K, right? So they're still okay here. But right now, if we want to see sustained upside momentum in Bitcoin, we do want to see it right above the 73K region, right over here where it goes back up the 50 EMA. And that's where we'll be more certain that the market is more on a risk-on mode for cryptocurrency. But we should also see this being reflected across the three major indices as well. Now, I did share about Oracle yesterday, who were releasing their earnings, and we've just got their earnings result. And as you can see, they did one of the most significant earnings surprise of the day. In fact, I will say that yesterday they are the only company that the whole market was focusing on for earnings. And as you can see, after hours, it is up at about 9% now at $162, which is in line with this short-term resistance that we see right over here. And if you look at the results, EPS was above estimation, revenue was above estimations. Their cloud infrastructure actually grew 84%, driven by demand for AI computing. So we are looking at their remaining performance obligations as well, which is basically the backlog, right? How much are customers buying from them? How much do they have to deliver? And their remaining performance obligations actually jumped 325% year over year to 553 billion, even though a bulk of it is from OpenAI. So that is still that concern over there. But with them raising their guidance to 90 billion, this result reinforced the broader narrative that enterprise AI infrastructure spending remains extremely strong, despite what we are seeing now. So as you can see, Oracle wasn't the first company directly involved in AI that we've seen reporting since the war started. We saw Broadcom reported, we see Marvell reported, and all of them are reporting very, very strong results. So what does this tell us? This tells us that with all the headlines focusing on the macro now, the overall long-term demand of AI is still there, right? So seeing this as an opportunity of this kind of companies being sold down, this might be good times, right, to look at companies which are right at the forefront of AI, right at the forefront of AI, and that might prove to be opportunities for you to add on to these positions. Now, diving deeper into the technicals, you can see that right now is at this short-term resistance, but we have to see when the market opens, because all these areas that we see right over here, the 50 EMA, the 100 EMA, as well as the 200 EMA, these will be very strong resistance that we do want to see Oracle breaking. Otherwise, we might see generally pushing up to the 166 and pulling back. So, and as we know, geopolitical in the short term, it still affects it, right? But the truth of the matter is the fundamentals are getting stronger. But right now, we do want to see hold above this 162 region, and at the very least break past this resistance and holding that as the new support. Now, what's my overall take? It is very clear that based on Tuesday market action, there is a delicate balance right now between geopolitical risk, inflation expectation, as well as market positioning. The collapse, the intraday reversal of oil prices offered temporary relief to inflation fears, but uncertainty surrounding the US-Iran conflict will continue to inject volatility into global markets. Now, news are changing every 24 hours. Tomorrow, I'll be reporting about what is happening next, as well as any changes before we know what is the next move ahead. And coupled with CPI data that is releasing today, this uncertainty is far from being over in the market in the short term. So it'd be very important to see whether the S&P can maintain support like we shared earlier around the 6,700 area, or whether another wave of selling, which might also come from the CTA that Goldman Sachs and JP Morgan shared, which I shared earlier, will actually push the index to a deeper correction. Now, that's all that I have for you for today's video. If you enjoy such content, be sure to hit that like and subscribe button. It will really help me to create more of such content for you. So thank you, and I'll see you in the next one.